First flight of the orbital Discovery, and the shuttle has cleared the tower. Discovery's core computers now have primary control of critical vehicle functions.
Hey guys, what's going on? We are here live with BAMinvestor. We're pretty stoked about this interview today. We've been having it planned for what is it, a week or two or so. So I'm excited to be able to introduce our community to BAM. We have some questions that we have come up with and the community's come up with and everything. So I guess we'll dive right into this. Lady, if you can kind of give us a brief on what we'll be talking about today.
Yeah, so actually, why don't we just dive into a little bit of your background, if you don't mind, just giving a little bit of who you are, your background, and kind of what you do.
Yeah, so some people call me BAM. My real name's Jim Savoldi. And BAM stands for Behavioral Analysis and Markets. It's something I've been developing over the past almost 30 years. And I worked at a hedge fund very briefly, a large hedge fund in San Francisco, California. I was seeded. The original idea was to create a commodities fund, which was my interest at the time. After I left the fund, they convinced me to launch the BAM report so that they could subscribe to my service, and that's how I started the service. That was 2005.
Awesome. Thank you so much. So we'll just jump right into the questions. How do you feel about the current market conditions and sentiments, and what do you see on the horizon?
So when you say market conditions, you mean the major averages like the S&P and the Dow and the NASDAQ, or is this?
Yeah, like the market as a whole.
Yeah, so the market as a whole is, super challenging for what I do, because the human emotion is being trumped by the amount of fiscal ammunition, and it's not really a free market right now the way it trades. So there are a lot of different influences that haven't been in the market before. I developed my model by studying the 1929-30 stock market crash and the 1987 stock market crash, and then the periods of euphoria that led up to those points. And the most crystal clear sort of data outputs I get come when human emotions elevated. When someone has their real live money on the line, they act a lot differently than they would if they were in a planning session or a professor presenting to a class talking about a hypothetical situation, or an economist or a talking head on CNBC or Bloomberg. So my idea was to dive straight into certain market environments and try to figure out what caused, the boom, what caused the bust. So the current market environment, I mean, we'll see. The jury's still out. Maybe my model will break completely in the stock averages and just not work. But I think we'll know within the next number of weeks. We'll know the answer to that.
Thank you. I think we're all kind of waiting, sitting by waiting what's going to happen, right?
I mean, this setup here is, I've said to subscribers and said to people, publicly and privately, that the market right here, the major averages in my model are more bearish than they were the summer of 2008. And my model did predict that huge move to the downside in crude oil and in the stock indices, and even with some a lot of detail as far as which sectors would be hit the hardest and the soonest and things like that. So it's what I call a really fragile tape. So if we're hit by any type of global macro surprise with the type of leverage and margin that's involved in the market right now, I think we're in a situation where the risk outweighs the reward. And so that's sort of my approach.
Thank you.
Hey, I am getting some information. Bam, Jim, if you are able to put your name instead of some weird phone number, or maybe it's your, I don't know what numbers these are that we're seeing, and I will try to figure out how to edit that out if I can. Thank you. I don't know what that is. I'm not going to assume what it is, but I just wanted to point that out. Thank you.
I just went ahead and corrected that. I believe it was the local call-in number he used for Zoom. So I just changed his name to Bam, but we can change it to whatever.
Okay, yeah, that works. Thank you, guys.
No worries.
So Citadel, I think you're on to the next question. Thank you for answering that.
No worries. So I'm just kind of curious, like, I've read up on, some of your studies and, prior market conditions, and I concur with you. Your history is most definitely destined to repeat itself time and time again, as it has, at least in my opinion. But out of curiosity, how were you able to, for example, psychoanalyze, obviously not getting into anything proprietary, but psychoanalyze a trader, whether that be retail or otherwise? And was this the data that you gathered? Is it generalized, or did you do like a field study, etc.?
So it's not. So I don't do any quantitative analysis. So I don't gather big data on sentiment or anything like that. 100% of what I do is price-based, and it's basically applying rules and personalities to structure and what I refer to as temporary capitulation and permanent capitulation at each fractal time frame. So basically, it's just I tapped into a way to figure out when price structure reaches an exhaustion point based on sort of like maximum optimism triggers that start a count, and then each successive higher high adds another number to the count. And then the same thing in a bear move, a maximum sort of pessimism number or whatever it is that drives my count to start, and then a series of sequential lower lows. And I track those at every, well, not every, I track those at multiple fractal levels. So I apply all of those to different price bar timeframes, the monthly bar of data, weekly bar of data, daily bar of data, and then I go through a whole series of different incremental timeframes that I found to be most useful. I used to have a greater number of different kind of nesting fractals, but then I found that there was a lot of overlap in a few of them, and they didn't really provide much more information. But I do go all the way down to a 25 tick level. And so what I found was just basically that the same counts repeat over and over and over again to the upside and the downside, and that the small degree fractals at the nesting level, you might have, you know, 2 or 3 miniature bull and bear market moves over a 2-day period down at that 25 tick or my 15-second time frame model. And then one of those moves of a series of bear and bull moves and full counts up and down and up and down and up and down in that small degree fractal will equal maybe a single count in one of the fractals at the next higher degree or a few higher degrees. So anyway, but all of my work, there's one premise I use, and that's that if I find something that I think has meaning at one fractal level, and it doesn't repeat at another fractal level, I can't observe the exact same thing that happens over a 3-hour period, unfolding over a 30-year period or a 15-year period or whatever, then I throw it out. And so when I finally saw what I thought made sense as far as certain count and a certain structure from 1926 into the 1929 stock market high, and then the crash down to the bottom, and then again 1985, 86 into the 87 top and the crash back down. Once I found what I thought looked like I was onto something, then I immediately kind of dove down into the 5-minute and 1-minute level, assuming that if it was real, I would see the same sort of structure in small degree, you know, wave counts up and down, and I found that was true. And so that's basically what I use. I have a completely different tool that like predicts future zones of strength and weakness. And then there's a whole series of tools that tell me help predict velocity and how strong the advance of the decline can be. And then I do have some stuff that's more like standard technical analysis, although it's not something that you'd find in a book. It's like some things that I sort of made up on my own over the years.
Understood. Thank you for some of the context there. Just out of curiosity, what, again, avoiding anything that's proprietary, but what is the human element, or you know, the emotion or psychology, how is that accounted for either in the fractals or your tool subset? I'm interested in how that's, whether metrics, how that's weighted. If you were able to elaborate, out of my own just for my own edification, because I find it fascinating.
So it's I was actually talking to someone about creating a graphic, sort of an explainer video graphic that goes through a little bit of this. But the way I've always looked at it and tried to explain it is, if you're familiar with like Russian nesting dolls, where you open the larger doll and there's the smaller doll inside it, and then that one can open up, and there's a smaller doll inside that, and then it goes all the way down to the solid wood, you know, little 1-inch tall doll in the middle. So if you think in terms of if you were to open all of those up and set them up on a table from left to right, you'd have basically my monthly model on the far left-hand side, the largest, most powerful model, and then it would work its way all the way down in time. So I basically just came up with a bunch of rules that, and these aren't perfected yet. We're going to actually use some AI to try to figure out through, just back testing and using AI to figure out exactly, what the answer is. But I can come pretty close right now with, ideas like if, the four smallest dolls collectively were all projecting and predicting a zone of strength, is that powerful enough to overcome the next most powerful doll size up if it's trying to force the market down? If it's bearish, and another way to look at it is, like tug of war. And if you have, these different people on one side of the rope and other people on the other side of the rope, and some are massive and some are skinny, but you can have skinny guy that's, really strong. You could have a 105-pound woman who's stronger than a 180-pound guy. So I've tried to just figure out how all of these balance out. And when you have a lot of push and pull in markets and volatility is low, that's when it's really difficult to figure it out. When you have a setup like I had in 2008, it was dead simple because it was the largest time frame fractals all pulling down and very little influence trying to pull back up against them. And when they were trying to pull up against them, it was just, intraday noise, 1% bounce, and then, within a crash leg type of thing. So that's sort of how it works. And it's even now it's a work in progress, and I learn something new almost every day. All I can say with certainty, though, is the more volatile a market, the more volatile a ticker, whether it's a currency pair or a commodity, an individual stock, an index, a 3x levered bull or bear name, the more emotional, the closer it will track to my model. So in other words, when a lot of other people are very confused about the market, that's when my model does the best. When everyone knows what's going on and we're in a very slow grinding uptrend, and you have the Fed put at your back, and you have tons of stimulus and monetary policy on your side, that's when, at least stock index wise, I'm not very good.
Okay, I am picking up what you're throwing down. That clarifies for me. I'm kind of curious. Given that your model, it says, as a general rule, it can be used to generate information about future price movement in any market as long as the primary traders in that market are human beings. With the advent of AI, HFTs, hedge funds using different algos, how is that affecting the model? We can get into like specific examples shortly, but like in general, I'm curious. If there's less, primarily humans is ambiguous. So it's the humans code the software or they're directing the algorithm.
Yep.
But are you talking about actual humans placing trades? And if that's the case, I'm wondering how the HFTs and algos and so on and so forth, which seem destined to take over a majority. We see things, securities barcode all the time. How does that factor in? Are you planning? Is there an adaptation? Is that quote unquote priced in? I'm just curious.
No, so far markets seem to trade pretty true, and like you pointed out, the humans are building the algorithms. So if people are familiar with the Market Wizards book that highlights different traders and talks about Jesse Livermore's career, from the time he was a tape reader and when he started to understand how to manipulate markets. If human beings are writing the algorithms, and you would want to have, let's say prior to having perfect AI, you would want to have the input from the best traders in the room. And once you had the best traders in the room describing to the coders how they gain an edge and how they're successful, then obviously they start to code that, into the algorithms. Really the only thing I see that looks really different, much different than this market structure in the past, is that the algorithms do game price and tend to run stops. So, especially if the same guys who are writing the algorithms and the same firms that are employing people writing some of the most powerful algorithms, if they're also market makers, and if they also have visibility into order flow, especially from the so-called dumb money, the people who are more likely to have a stop loss sitting right above a series of price highs or right below a series of price lows, then it's fairly easy for them to write algorithms to jam into that area, especially if they think you're a move's near exhaustion, because as a move is near exhaustion, typically volume is shriveling, and as volume shriveling, that doesn't give them the opportunity to have the position size they want out of a turning point. So, if you were writing the algorithms, you'd say, okay, let's jam it through some stops. Let's go seek out some volume so that we can load up before the market moves in the direction we think it's going to move in, or the direction we are about to take it in. So I see more expanding patterns because of that. But they still have the same rhythm of human emotion. It's just that at the margin, it seems like these guys are able to push price a little bit farther in each direction, up and down. And so, that's when I really started to employ my strategy of sort of a 4-unit approach, investing, buying at in four separate units, or selling short in 4 separate units. And then if I have a real high confidence entry, maybe I'll deploy 2 of the 4 units in a single first trade, and sometimes I'll deploy even 3 if I think I'm real close to the actual turning point. But then I personally, if something's not automated, because I do run automated algorithm strategies, but if it's not automated, I'm the one pulling the trigger. I like to admit that I'm going to be wrong ahead of time. And the best way for me to tell my brain that I'm going to be wrong and give me some sort of put me in a spot emotionally where I'm not even nervous, the best way for me to do it is to say, admit before I even pull the trigger that I'm going to be wrong. And the way to do that is for me at least, is by just deploying half the number of units, long or short, that I plan on deploying. Because if I go straight into a trade all in on the first, when I first see a signal, or all out, just for me personally, that's like training my brain that I must be dead right. Otherwise, I wouldn't be deploying all the capital right here at this spot. So I have noticed that, there's definitely extensions in my account. There's nothing that says as soon as my topping count or my bottoming count is complete that price can't continue to chop to extended successive higher highs or lower lows and extend my account. It happens more often now, and especially intraday on the intraday accounts. And I think that's just a function of, how busy these algorithms are and how easy it is for these large firms to make a ton of money by ping-ponging markets. They don't want flattish, boring markets. They want to find pressure points to make you capitulate. And that provides the volume they want.
So to just kind of pinpoint this. So what we talk about a lot in the BullHouse is, taking out emotion when you're investing, when you're in the stock market, because they do trade against computers. So your model basically helps people to do that. So I mean, obviously you're still going to be human. You're going to second guess what a computer is telling you. And I'm seeing some people like, does your model help again, predict against like the manipulation that we may see, or the high frequency trading or synthetics that might be out there? Does it account for that as well? Or is it simply like straight data, here's what it is, what it can find? And then if that's the case, like how does one prepare themselves emotionally to say, okay, this is what the model is showing me. How do I also make sure I'm doing the right thing given what we think we know?
So, I've talked to a friend of mine who ran a large market making firm that he sold to a major bank. And I actually, he's committed to an interview, but I gave him a list of questions, and, there are just certain questions that he's either, he just doesn't want to answer, doesn't think he has any expertise in or whatever. So, I personally think that, and what he told me is that when it comes to dark pools, the rules state that, eventually that volume is supposed to find its way into the consolidated tape. So if it does, and if I can see it, and if I can capture the data, I have the data that I use is supposed to be as good and as clean as any data you can find. So assuming that people are following the rules, and no matter where a trade is executed, assuming it's eventually and hopefully fairly quickly reported and reflected in the consolidated tape, then, I think what I do will continue to work. And, I'll always have to make adjustments, and I'll probably see, market structure change a little bit here and there. Matter of fact, one of the key tenets of my whole model is that markets have different personalities. And so if you think in terms of like someone who's a cycle specialist and they follow business cycles, or, the 7-year, 10-year business cycles, solar flare activity, drought cycles, tide activity, all these things that drive the real world and real life and real humans, even women with their cycles. So obviously there's cycles all over the place if you want to go track those. Something I figured out a long time ago, I think, is that there are certain periods throughout history where human beings are more resilient than at other times. And so each individual ticker has its own personality. And then even within that personality, it goes through different periods where the bulls are more resilient or the bears are more resilient. And so when they're more resilient, you have to press a lot harder against them to get them to capitulate. And when they're barely resilient at all, you barely have to do anything. And that's when the count tends to hit, dead on and turn from a high to from an uptrend to a downtrend, or vice versa. So, I personally believe, based on everything I've seen, that it's not like a one size, fits all. Like even in technical analysis, if you were to try to look at a utility stock and compare it to a SPAC or a 3X leverage name, obviously they look a lot different. So, one of the first things I try to do is figure out the personality of the stock or the commodity, currency, whatever it is, and then also try to be really aware if even within that sort of long-term personality, if the child is changing its behavior and starting to act out or act different or whatever. So
yeah, I agree. Yeah, because we at BullHouse, like we do hold AMC, we do GME, and everything, but we do watch like everything, the commodities, the cryptos, the stocks, real estate, you name it, we're watching it. And what we found is that it all ties in together. Like, if real estate goes down, well, the same people that are invested in real estate are invested in the stock market and commodities like gold, silver, and whatnot. So no, I definitely agree with that, and you have to watch it all. So I know I'm totally taken away from the questions, and you don't have to answer this at all, but um, my big thing with your model, because I'm very intrigued at this point, is that I've done some major DD on historical cycles. So the 1929 to 2020, crashes and things, and then 1820 and stuff. And so I was wondering, is your model seeing any kind of crash or correction or any whatever you want to call it, another crisis that we've seen in the every century? Does it see anything like that coming up, given what we see with the markets at the moment?
Yeah, it's definitely even to the point where I don't really like to talk about it, to be honest with you. But
oh, we talk about it all the time. Sadly.
It's there's when so there are certain points in history where a lot of sort of long, let's see how to put this. So what I do doesn't depend on cycles.
I was going to say, you can speak as freely as you want to. You can speak as freely as you want to. You won't be.
Yeah, I know. I understand. When there's sort of a map of the future sitting in front of you, and you think it's probably going to play out because it worked in 2008 and 9, and it worked in the past. It's you don't want to add to. I personally don't want to add to any sort of bad outcomes. So I mean, I forecast things exactly like I see them for the service. I just don't want to, I don't want to be the guy screaming fire. But so in general, my model is, as I said, more bearish than it was in the summer of 2008. So, that is sort of a period we're in here for the next 2 or 3 years that just looks like just a big problem. So
I appreciate that. Yeah, no, I've said it all. You can continue on with your questions. I appreciate you answering that because it basically confirmed what we've been seeing and studying. So I appreciate it.
Yeah. So in my but just to give you an idea, if someone's a subscriber, they know that I'll have a forecast in place. I'll have zones of strength and weakness. I'll be talking about the which of the fractal time frames that data originated. So obviously, if I have a zone of strength of 3 days from now, and it's coming from my hourly price bar model or something at a higher degree, it should play out and be fairly powerful, as opposed to something coming from my 1-minute model or my 5-minute model. So subscribers will tend to notice that I'm able to add intraday data, fairly frequently sometimes, and there'll be other periods where nothing's generated for 2 or 3 days. Well, if you move all the way out to my monthly model and the weekly and the daily, my 3 largest models, the period we're going in here, this bearish zone of weakness that we're heading into here, is something that was generated 35 years ago. So it's a big deal, and that's why I'm saying that this is more bearish than my model is more bearish than it was in the summer of 2008, because some of that data had also originated 20 years earlier. Matter of fact, some of that data had been generated from the 1987 crash, and so that's one of the things I've been studying recently is there significance to some past period of euphoria or depression that would project more important data forward, or is it just the same type of data? If it's a zone of weakness that was generated from the 1987 high and crash, is that the same as something that was generated from, you know, some other 20% bear market 10 years ago? Or is there some significance? Is it almost like genetic, where you can count on it being even more important because it was born out of an event that was historic?
I mean, that's awesome. I mean, to know that
Is that crazy enough for you guys?
that is, I mean, no. I mean,
So just to let you know, I was having drinks after work one time with a guy who's, you know, very, very sophisticated, very smart, very skilled hedge fund guy. And he pressed me a little bit on some of my stuff, because they just used to call it voodoo. They just say, hey, what's your voodoo say about whatever? And so I started to get into it a little bit, not even deep, but into it a little bit. And he looked up at me and said, hey man, don't ever say that out loud in front of anybody else ever again.
yeah, I think that's
it was just too nutty sounding.
yeah, it's oh trust me, I feel nuts most days, because like my goal is to try to help people avoid the devastation they had in, you know, 06, 08, 10, 12, you know, these crazy years that we've seen. And because, you know, my family was affected, and a lot of our community's families were affected by 08. And so if we can, you know, help prepare people and kind of get them into, you know, guide them towards, you know, what is kind of recession or depression proof, you know, land and things like that, you know, it's my goal basically. So to hear that we are on that right track, to say, okay, because, you know, it's a big question I get asked, like, okay, if it happens, what are you investing in? I'm like, land, shelter, water, period, because those are your three main necessities of life. And so to hear, you know, it's not nutty. It's not nutty. So I'm very happy that you were willing to share that with us.
Where the data comes from and what it might imply, that's the nutty part. That's why I don't get into it anymore.
Completely understand. Citadel or Kringle, Maverick, I think you guys had questions coming up. I totally derailed it. I'm sorry.
No worries. My last, you covered actually a couple of my questions between Kenna and actually answering my prior questions. So I only have one last question before I hand it over to my colleague Kringle. It's only for, again, my personal edification, because I found myself doing something similar. But forgive me if I'm wrong, but your degree is in criminal justice, correct?
Correct.
How does one...
Barely.
I hear you. How does one... Obviously, not everyone goes into a field where they're, you know, they have their undergraduate degree in. But I mean, but I'm just curious, how does one progress from criminal justice into the world that you are in now? I'm just quickly what the backstory was. I'm just curious.
ADD.
I 100% hear you. That's it's a fair answer. I only asked. I get the question myself quite often. You know, I went to business school. Realized it wasn't for me well after graduating, and then later in life went to medical school. So people are often quite confused when I have a, you know, dual degree in that nature. So I was just curious, but I completely understand.
So I've mentioned in an interview with Randall Cornett how I sort of became fascinated by the stock market to begin with. And so my grandfather was a famous athlete, and I was in college. I went to Auburn University in Alabama, and I was in the library, bored out of my mind, supposed to be studying, and decided to take a little break over the microfiche machine and look up some New York Times newspapers about my grandfather's football team at the University of Notre Dame. So he was a fullback. They won 2 national championships undefeated. And he was a big star, and I had seen his scrapbooks when we would visit my grandmother's house, and I just wanted to look it up and, whatever. So I was, as I said, he played on the 1929 and 1930 teams. So I was reviewing all these different sports page articles about his games and all of this stuff he did. And, flipped the reel, and it was the business section. And I saw this thing that's, stock market crash, huge bold print. And I just went down the ADD rabbit hole. And, anytime I moved off into sort of a different pursuit, I always got sucked right back into trying to figure out why the hell that happened. And here I am.
No, I appreciate it. I can relate more than I can convey. So I respect that. For better or worse, I mirrored a very similar experience, much to my family's chagrin. I'm going to turn it over to my colleague Kringle. He has some questions lined up.
Yes, hello. Good evening, Mr. Savoldi.
How's it going, Chris?
Yeah, pretty good. Thank you very much. Thank you for coming in. A lot of institutional firms use several predictive models for the purpose of security forecast on the market. So a large part of the community is wondering if the BAM model account for severe market manipulation coming from bad actors, such as allegedly coming from nefarious short selling hedge funds or leading market makers.
So again, if all of the trades are reflected in the consolidated tape, then theoretically I can see that data, and then I can apply all of my different rules to that data. So that's one thing. But the other question about manipulation, I'm not positive, but I think I can see it at times. I think at times it's fairly blatant. As a matter of fact, and I think I can also see, when people are cheating. And I think it's the worst kept secret in the world. I mean, look at options volume in a biotech stock prior to an announcement that's supposed to be a shocking announcement about some, trial results that are stellar and something that's being fast tracked. I mean, I don't know why it's overlooked, but I think it's right there in front of for all of us to see. So, I think there are probably some things that I see occasionally. I mean, who knows? I might be completely wrong. I just know there are things that I see occasionally that look completely different than, everything else that sort of unfolds in really a pretty predictable way, actually. I just don't see a lot of unpredictable moves happen in markets. I do see prices overshoot, like I was saying, and I think I know why they overshoot. Matter of fact, I have, a term, last gasp. It's what happened to the mortgage brokers before the big crash of 2008. And it's I think it's a combination of a bunch of really smart people that know when they should be short or long something. So let's say in the case of the mortgage brokers, they, like the movie, The Big Short, and all the other newspaper articles, there were a lot of people that saw that coming or thought they saw it coming, including some guys that worked in the credit field in space and at that fund I worked at. Who were able to retire shortly thereafter. So I just remember in the case of the mortgage brokers that they kept chopping to higher highs, and you could tell it was, a function of people selling short and selling short, all at once, and probably with larger size than they were comfortable keeping. If the market wiggled against them at all. So as a result, they get really big size-wise, and then they get stopped out, and then try again, and they get stopped out. And I'll never forget when a couple people I knew who were trying to short the mortgage brokers we're finally stopped out into the high, which in my model was sort of this last gasp. And I don't know if it's 100% natural or if it's some very large fund that knows that either the market's about to come unglued or they're about to make it come unglued. I really don't know. But all I can say is there's that last gasp move. And then I'll never forget the people I talked to said, well, I'm just going to sell a bounce on the way down. And these are guys who've been stopped out 2-3 times into the top. And then finally they decided they're not going to try to sell strength again. They're going to sell a bounce on the way down. And they just dropped literally 50% in, the blink of an eye. And there were never really the types of bounces that were deep enough for these guys to pull the trigger and get short. And then they looked up, they lost money into the top. Mortgage brokers were down 50% and they were still just sort of like flat-footed. So, I do think that last gasp looks a little manipulative to me in markets, but I can't prove it, and I don't know anything more than anybody else knows. I just know there are certain times at turning points where things look odd. I also, whether it's outright manipulation or a function of the mechanics of the options market, which I think could be one and the same. I do think that the pinning and some of the stuff that goes on Fridays around weekly options expiration is 100%, bogus.
Thank you. Yes, a lot of due diligence where, they have discovered a lot of disparity, and the community has discovered that a lot of retail orders have been rerouted to away from lead exchanges, and most of our option supply chain are underwritten by market makers, and a lot of them have been used to suppress buying pressure, although it's really hard to prove. What would you say is the percentage accuracy of the BAM model overall?
So my crude oil model was, when I was tracking the live trades, which I did for years, my crude oil model was my most accurate model, and it was in the 80s. Probably my most inaccurate model probably would have been as far as percentage wins would probably be my S&P model, but not in percentage, gains once it caught the right moves in the right direction. The crude oil model was my most accurate, and then in general, as I said, if I were to only forecast markets that are highly emotional, in other words, if I didn't have a set list of markets that I forecast, which I have over the years and I do right now, then I think that the accuracy could be in the 80s and 90s even in certain markets at certain time frames. I know you guys in the question list you sent over, you asked a question about a Nimoy. So a Nimoy is basically an automated version of some of the things that I figured out in BAM, and we're doing back testing and continuing to do more back testing on a Nimoy, certain strategies and setups, and I think the results there are going to be really, really impressive, and I'll be able to quantify those with set back tests against different tickers and be able to share that with the public.
Awesome. Thank you, Mr. Savoldi. Now I'll pass the baton to Maverick, who is a very, very big fan of your work.
Thanks.
Hey there, Jim. How you doing?
Hey, good, Maverick.
Awesome. Well, it's nice to speak with you. And just before I go into asking a couple questions more related to actually following your model and so forth, I know that you mentioned it several times in your videos that people might get upset or emotional and send you tweets and so forth. I've kind of seen them myself, but I could say it with certainty that there's a big majority of us that are big fans and that appreciate the work and the efforts that you put to help the community. So even though you might not see those as much, just want to say that it is appreciated by many in the community. So that being said, I had a question regarding if you could elaborate a little bit more on the differences, particularly when you're speaking regarding information or data coming from the 1 minute, 5 minute, 60 minute, and obviously there's more, but regarding, do the models from these different timeframes change more often or less often depending on how far away it is? Can a 5 minute model overpower something that is 60 minute or weekly? Like, could you just go a bit more in depth into making kind of really easy for people to understand kind of what's more powerful and what can affect those models as obviously, you know, day-to-day users come across your information?
Yeah, so the more active a market is, the more data is generated as far as the zones, future zones of predicted strength and weakness. And so let's say in a typical trading day in a stock that moves around like AMC, we'll use AMC as an example. In AMC, well, I'll tell you, I'll take a look right now and I'll give you a few real life examples here just for the heck of it. So in AMC, my 5 minute model that is produced, that is generated 1, 2, 3, 4, 5, 6. So my 5 minute model right now has 6 future zones of strength that have been generated, okay? And those span between now and all the way out to August 23rd. And what's interesting about the market is in the past, my 5 minute model it'd be more typical if it had generated 6 future zones of strength for those all to play out over the next 2 or 3 days. So there's something that's changed about the market that's almost stretched time. You know, I don't have any expertise in physics or any higher mathematics, so I'm probably not even really stating that correctly. But I mean, to my eye, it's like there's something, a new dynamic in the market that's almost stretched time. So just to give you an idea how long it took to generate those 6 zones of strength, the one strength into the 23rd was generated early last week. The zone of strength into sort of the 18th, 19th, a couple zones of strength there, they were generated all the way back in between July 8th and the 14th. So that's real unusual. It used to, that didn't happen in the past. And I'm not certain why it's happening, if it's, you know, specific to AMC, specific to the market structure and, you know, more algorithms, I don't know. But so in general, you know, like I said earlier, the zones of weakness that were clustered in the 2008-9 crash window, especially into the fall of 2008 when Lehman went down and the market crashed, you know, those were, you know, the monthly model went back decades to generate that zone of weakness. So, you know, in broad terms, the bigger picture of the model, so the monthly model, the weekly model, the daily model, those are generating zones of strength and weakness that can be, I mean, some of them are 50, 60, 70 years into the future. Others are, you know, 30 years into the future. A really active monthly model, let's say like a Tesla, that really flies around price-wise and flies around in a relatively short period of time, calendar-wise, might generate a zone of strength or weakness this year that projects only 3 years from now. So that's sort of how it works. And then when you're down at that 1 minute level, depending on the market, you know, my 1 minute model could be generating future zones of strength and weakness that are the same exact day, or, you know, a day or two in the future. And then remember, I go all the way down to 30-second, 15-second, and 25 ticks. So there's just constantly, if I shared that with everyone, it would be too noisy. So what I'll typically do, like with BAM, is when we had the big move in AMC during May, it was the way I was able to predict that is because we had three things going on. We had retest levels to the upside, so I knew where the price bogeys were, and they were, you know, impressively higher. And then we had what's called an expanding megaphone melt-up fractal, which is something that I kind of figured out on my own based on the 87 crash. And so it's basically a 87 crash flipped upside down. And so, you know, it turns into a melt-up as opposed to a crash. And then we had a bunch of sort of bullseye zones of strength coming from my bigger picture models that were all colliding in a cluster of calendar dates into, you know, that mid to late May to early June time period. So like in the S&P right now, and especially in the Russell 2000, which is the most bearish index I'm tracking right now, you have, you know, all these zones of weakness that collide. Some of them were generated, like I said, 30 years ago, but they collide down into, you know, the fall, you know, some of them starting in August here, and then the fall, and then over the next 2 years. So those are fairly long-lived. And what I'll do in stock indexes is, unless stock indexes look completely different, like let's say sometimes the NASDAQ is bullish while the Dow is bearish or vice versa, I will cheat to the extent that I'll borrow, you know, one zone of weakness that's been generated by the Dow and combine it with a zone of weakness that's been generated by the S&P, even if, you know, they're 2-3 weeks apart or 2 months apart. And I'll assume that those indices are similar enough to where I can kind of mold them into a single forecast for the major averages. But outside of that, every single market I track, I try to have real strict discipline and only use the information generated from that specific model. So like right now, in the case of even gold and silver and the US dollar, you know, most people would just assume they always gold and silver trade inversely to the dollar. If my model's predicting that they're all going to go up together or down together, I just put the forecast out there. You know, I don't try to second guess it, and I never use like the dollar to predict gold. Whereas in the stock indices, if they look fairly common and they, you know, it's like the S&P and the Dow, they're similar enough, I will combine those.
Really interesting. So when it comes to those data sets that are coming from these different models, is there a correlation between if the model is coming from something farther out, is it more certain than something, let's say, at the 1 minute or 5 minute level in terms of its accuracy? Is there a correlation between that?
No, but there is. It's all about human emotion. So if you know, if there were an individual VIX for AMC, in other words, probably not a great way to put it, but I can sort of tell. So if I'm, like I said, if my service, instead of having a fixed set of products, so, you know, I just happen to basically emulate some of the other services that already existed and some of the markets that the guys at the hedge fund wanted me to take a look at, and the women at the hedge fund. It was, you know, the S&P, US 30-year bond, US dollar index, gold, crude oil, the VIX, the VXO, the VXN, the Russell Volatility Index, you know, those types of things. And then, you know, of course, I looked at individual stocks, you know, while I was working there. And then once I started the service, it's just, I can't keep up with, you know, a ton of different tickers at the same time. So if I had my choice, I would basically only be forecasting the most active, crazy, highly emotional tickers, whether it was a crypto, ticker, or an individual stock, a SPAC, whatever. And when they cooled off and they started to, and I could tell that they were going to go into sort of a noisy, choppy period, I would just back away. Unfortunately, I can't do that now. So when we go into some of these periods where I know ahead of time my accuracy is probably not going to be as good as it was, I'm still forced to, continue the forecasts every day. And what's worse was with like AMC, I told everyone when I got long that stock May 4th at $9.19 that I was not going to sell until I had the completed topping count and we had gone through the different zones of strength and everything else. So even though my model was very bearish during July and, predicted that we would have that, big rough period, I didn't short it. I couldn't short it. And I really didn't, talk too much about, the downside. So you're basically forced to continue to forecast the stock that has shrinking volatility and a downtrend when all of your clients are people who want to see a melt up.
Yeah.
So hopefully now that we've moved into August, which was, forecast all the way back in April, May, my August zones of strength were on the board. We've added new zones of strength coming from that 5-minute model, like I just shared with you guys. And in the 1-minute model, and the 30-second and 15-second, I can see them winding up and also kind of shooting zones of strength out into the same dates out ahead. So, that's why I'm kind of consistently tweeting out positive messages about, AMC, and especially again today when it was down and I made the tweet, sent out the tweet that I did.
Yeah. And for the month of July, I'd seen a forecast, and you handled it pretty cool, and it was really well done, and I wasn't worried because you kept us all in the loop, so we appreciate that. So if we go into kind of talking about the differences, the real big differences between the BAM model, and a lot of times you tend to refer to a Nimoy. What would you say are the big differences between the two? Or is there any difference between the two? What can you say about that?
Yeah. So a Nimoy doesn't fade at all. A Nimoy is more, the algorithms were built and the structure of it's built to be more recognizable to momentum traders and to people who are more comfortable going long into strength and shorting into weakness. Whereas, if you follow BAM, you'll see me, with a sell short signal set up over the top of consolidation that would be trading up to a new all-time high, where most people would be placing their stops. So, BAM, if you look at it, it's a hugely contrarian model at turning points, because that's what I'm tracking. I'm tracking, this count, this bull count to the upside, and when it hits exhaustion, I'm the guy in there exiting long, selling short, and then same thing into the hole. So it's one of the reasons why I think I'm so controversial, in addition to the fact that people just don't like to hear you use the word predictive, prediction. They just think it's a bunch of smoke and mirrors bullshit. So anyway, that's the huge difference, is that BAM, you'll definitely see BAM making hugely contrarian calls. 2008 crude oil trading at 147. I had a forecast for a crash to $36 over the next 6 months. And then what happened was crude oil crashed at 36, but it didn't even take 6 months. It took 2 months. So I was actually conservative on that. But, I could go back and show, I keep a little folder of like comments and hate tweets and everything else. And a a lot of it's orchestrated and paid propaganda specialists, especially now that I have a decent following. But even going back, it just makes people furious if you are talking about something that's completely against everything they're reading in the newspapers and watching on TV, and especially someone who has a degree from a great school and they've spent their whole life studying economics or whatever, and then a guy like me comes out and tweets something about that's completely contrarian, and I have nothing to back it up with because I won't show you the sort of black box portion of my model. So I kind of get it. But anyway, that's BAM. It's very contrarian, very controversial, and performs best when markets are highly emotional. So people are already mad because they tend to be losing one way or the other, and then this thing tends to be right. Nimoy, it has one dead simple rule, and that I built into all the different strategies. I have 15 different strategies that I run, and the one common rule is that if the stock is in what's called a bullish condition, meaning that price is above my hourly trigger, the bot can only go long or flat. And if price is below that hourly trigger, the bot can only go short or flat. So the way I designed it, it's not contrarian. The only exception is there are a few strategies that we've set up where they're sort of mean reversion plays. So if price is super washed out and it has a certain delta comparing price to hourly trigger, which is historically stretched, the bot is allowed to go long below the hourly trigger. So it's in a bearish condition. He's allowed to go long on a reversion trade. And then the same thing with the market stretched to the upside. So there's no human intervention involved in an Nimoy. It's 100% automated. The bot tells you can type in a symbol and the bot will tell you whether it's long, short, or flat. It's if I get hit by a bus tomorrow, Nimoy can keep running. Whereas if I get hit by a bus tomorrow, BAM's done.
And I believe you are planning on releasing a Nimoy to people to basically subscribe to that. Is that correct?
Yep.
Awesome.
So BAM was, BAM, we had a major cyber attack right into that May, acceleration period. And it was a huge problem. It took weeks and weeks to recover from it. Now I have, full 24/7 monitoring of everything in my office, and they can watch people, trying to hack me and trying to do whatever, and they kind of take care of it. But we knew based on that, and based on history, they always wait until I'm about to launch something. Like if I've announced something publicly on Twitter and I'm about to start a new campaign or a new symbol or, cover a new market, that's when I'm hacked and taken down usually. So I kind of jumped the gun in telling BAM subscribers that Nimoy would be, up and running and open to the public really more than a month ago. But the security team's been, they have a team of guys hacking a Nimoy basically, and then my developers fixing the vulnerabilities as we go along. So that's the reason I didn't want to, BAM has a decent number of subscribers now, and I didn't want another huge embarrassment. And that's why it's taking so long. But I think we're within days. So knock on wood, I think we're within days.
I do have a question real quick, and I know Maverick has like one or two more questions. Because I'm seeing it's being repeated in YouTube 1,000 times. Do you think that with all the manipulation and the synthetics of what we're seeing, is that why your model's been kind of off this past week or so?
Really, we've just had, one more lower low. I was looking for that turning point low that came right before that 49% move to the upside. And then we were tracking perfectly again into earnings and the following morning. And then, I think what just happened was a orchestrated downside washout, either someone trying to create volume so they can get out from under shorts, or a combination of them trying to demoralize the apes and shake loose some volume to where they could, reposition themselves. So, I think what's about to happen is that we're about to take off, and that we're going to track really nicely into my August zone of strength, and that the intraday zones of strength and weakness will start to hit again. Today, the zone of strength did hit. And so, I don't see any reason why everything's going to all of a sudden stop working. It worked into the big advance, 700% move into May, June. It worked in the big zones of weakness during July. And, we're barely into August. And to me, it looks like the bottom's in and we're about to take off. So, we'll see. Maybe I'm about to be incredibly embarrassed here, but it looks good to me from my side.
Thank you for answering that. And I hope. I've been pretty bullish on August since, I think about April or May, just based on, data findings and things that I find. Nothing that's compared to your model by any means. Like, I'm so noobish at that, but, August was definitely a bullish month for me.
Well, the other thing about August that I can share with everybody, because you guys mentioned GME as well in this email you sent me. So, what's interesting is that, I came out and said that I was going to cover GME, months ago. And then it started to generate really bearish data, worse than AMC during July. And so it put me in a no-win situation. I either come out and tweet, wow, it's really bearish, and everyone calls me a shill, and I'm blamed for GME going down, which is, ridiculous. I don't have the power of following anything. But, that's not going to prevent that from happening. So, although AMC was very bullish during August and a handful of the other, so-called meme stocks, GME was not. GME was bullish and is bullish, that model, into September. And so I had this situation where AMC was very bullish during August, wasn't showing me any data for September, up or down really. And then was bullish after that. And then, of course, if you've been following me for a long time, you know that there's the most bullish zone of strength as far as, coming from big picture to powerful data, out into sort of December Q1 of 2022 for AMC. So all along, when, people have been mentioning a single event, this melt up that's supposed to take AMC to these certain price levels that people have talked about, it never really looked that way in my model, and it still doesn't. It looks more like a series of sort of mini melt up events, whatever you want to call it. To me, that 700% move was definitely in the melt up category. But typically, in those kinds of structures, it'll be sort of a one and done. So it's this big buildup, this kind of a coiling effect, and then you have the big event, and it's kind of a Roman candle, and it's almost like a penny stock type event in a large, cap stock, and then it's done. AMC from the beginning, even moving into that May period, if you go back and look at the first interviews I had on YouTube, I was telling people all along that if it tracks my model, it's a combination of these, ripping zones of strength, but then after pullbacks, another ripping zone of strength. And it's sort of like, almost look like a turnaround story in addition to a short squeeze story. So anyway, what happened with GME was finally, a couple weeks ago, it generated a single zone of strength into August, which is enough to then say, okay, now it looks like GME is going to participate along with AMC during August. I know GME already was bullish in September. I know AMC is bullish into sort of Thanksgiving-ish. So all of a sudden, I do feel comfortable combining these two models to to think based on history that we're probably going to generate some new data in AMC over the next couple weeks that fills in that sort of blank spot in September and then falls into agreement with GME. So that's my hunch. I'll tell everybody, in real time whether or not that's true. I already can tell that we're going to generate another additional zone of strength into sort of right around Thanksgiving-ish, about a week before. And if that happens, if AMC is bullish during August, bullish during September, at least in a limited window like GME is, and then bullish into Thanksgiving, and we already knew, for my model at least, that it was bullish sort of December / Q1 February. All of a sudden there aren't a lot of windows where the stock's not going up. So, I mean, we'll see. But what I've told people is that, there are times when I'm looking at my model and it's actually kind of hard to interpret what it's trying to tell me. I absolutely can see what it's trying to tell me right now. Now, whether or not AMC tracks that, perfectly or well or whatever, I don't know. But I'm confident that I'm passing along, accurate information as far as what the message that my model's sending me.
Oh, that is very cool. Maverick, do you have one more question?
Yeah, just one more, Jim. And I've noticed it, like you've mentioned it again quite a bit in different videos, even for BlackBerry, AMC. What makes that a retest level needs to absolutely be hit, either whether it's now or at some point in the future? Is that based on all the history that it just absolutely has to do that, or does something happen sometimes that it doesn't? What makes that those retest levels need to be hit?
So that was my first discovery in the 1929 crash. And then when I moved to 87, I saw it again. And then I started to, come up with this idea of what is it that creates market air pockets? Because if you guys study technical analysis, you know that, I could show people in the 1987 crash where when it started to roll over, almost to the person, or I would think 100% of technical analysts, if they've studied the books, would have thought there was tons of support under the market, and it just went straight through it and crashed. So, per my work and everything I've studied, the reason that happens, the reason it's able to happen is that there are these retest levels, or a whole series of retest levels, in the case of sort of cascade declines or cascade melt-ups like AMC. We had 4 different retest levels all the way up to 32, and that's what gave me the confidence that was going to happen. So to your question about, why is it that works that way, and why is it that it seems like market price must revisit those retest levels? It's, I'm just making, this is just my theory based on everything I've seen. But I think what it is markets need to be orderly, and human behavior needs to be orderly, not chaotic in the sense that everyone is in agreement all at the same time, either up or down. Okay, not chaotic, meaning up and down and up and down and up and down. That's actually much more healthy than straight up or straight down. So basically, it's fairly straightforward. It's trend line breaks. And so if you think in terms of the trend line, I know a lot of the younger people, I see them commenting all the time that, of course, a trend line works because everyone's drawing a trend line and they're looking at it. Well, you guys have studied market history back into the,
I got to 33 AD, so
okay.
I went all Julius Caesar all the way back.
Yeah, so you'll see those trend lines, and unless they were scratching them, chiseling them into a stone, and passing them around, they probably weren't, looking at bullish and bearish trend lines and price structure. So more likely what it is, and what I believe it is just a graphic view of human nature. So it's this thing that controls us. I mean, I personally think we're just puppets on a string, that there's very little in our lives that we control, and that, you know, we can be pushed and prodded, and there's certain periods that cyclically, they aren't fixed cycles, but certain periods cyclically when we're more prone to war and hate and love and all these other things. So basically, the retest levels are a function of, you know, human beings being too bullish or too bearish collectively in a moment in time. So what needs to happen is you need to have a bull-bear struggle and some indecision, and you need to move back and forth on certain levels, and then, you know, you can go ahead and continue the uptrend or continue the downtrend. But when you move violently up or violently down, that leaves behind this hidden retest that I figured out. And then once the retest is hit, I figured out that they tend to follow this, you know, ABCD type of rhythm, which coincidentally is the same thing that Ralph Nelson Elliott discovered with his Elliott wave theory. You know, the 5 waves up, I mean, the 5 impulsive and 3 corrective, and ABCDEs, expanding triangles, contracting triangles, all those things. So there's just something in human nature that creates these rhythms of price movement when the bulls are battling the bears, or just the buyers are battling the sellers. Because if you think in terms of somebody covering a short position, they're buying to cover the short position. They're not bullish. So prices, they are forcing price higher as they buy. So it's not as simple as just saying, you know, bulls versus bears, optimism versus pessimism. But that's the reason I personally believe that retest levels must be revisited. It's sort of the market saying, hey, you guys forgot to have this fight up at this level or down at this level. So, you know, keep in the back of your mind that we're going to have the fight at some time in the future, whether you want to have it now or not. So the most structured advances and declines always have a lot of that back and fill, and, you know, a little bit of a slight slope to the trajectory up or down. They're not just, you know, violent moves. If you see a violent move in any market on any time frame, just go and look at the chart, and you'll probably find there's a retest level left behind there.
Yeah, it was quite interesting the other day when we gapped up in pre-market and said, hey, we got to retest at 35.70. It has to happen in regular trading hours. And then boom, it's exactly what we saw. It was like, oh, right on. So thank you so much.
That 30.
Yeah, sorry, go ahead.
Yeah, so that $32 level in AMC that, you know, so, you know, when I first got long at $9.19, there were retest levels at 13, 17.45, I think. And then one more above that, and then $32. And that $32 retest level, that was generated way back in 2013, I think, something like that. And so, you know, that's where that came from. And so, you know, retest levels, the one rule that I figured out is retest levels are fast market attack events. So when you do come to the point in the future when they are going to be retested, once price starts to approach within a certain percentage of that retest, the final price move into it, up to the upside or the downside, is violent. And so if you think about it, when you have a whole series of them, you can have this cascading effect where it dominoes through them to the upside and the downside. And that's one of the reasons why the setup right now in the Dow Jones Industrial Average especially is, you know, there's no other way for me to interpret it other than when we do roll over, you know, it's a crash setup. Now, I don't think, you know, we didn't really crash in any single session back in 2008. We were limited to sort of 7% stair-step declines because we have, you know, different market structure now, and the people in charge want to prevent markets from getting, you know, so chaotic that it causes collateral damage, systemic risk, whatever. So I think that probably will happen again, that we won't hit all of my retest levels in a cascade. But if we did, we would have like a 1987 event.
Thank you. Thanks so much for clarifying some of these questions. Kiana, did you want to go to some of the YouTube questions that you
Yeah, if you have any more time for us, we've been keeping track of many of the questions coming in from YouTube. I mean, the YouTube chat's just been absolutely loving this. Some people are just now getting introduced to you. They're learning what you do. And I know that there has been a lot of misconception on you, and it's actually been very, mind-opening to me, because it's like, you can only get so much from Twitter. And so I think that's something that's kind of been, quieting your voice, is, the character limitation that Twitter allows. So being able to actually hear you talk and hear what you have to say and really go in deep on what your knowledge is, I think is going to be very, very beneficial for a lot of people. And I look forward to sharing all of your knowledge that you've shared with us tonight. So if you do have time to answer some of the questions.
Sure.
All right, Citadel, I think you've been keeping the notepad of that.
Yeah, let's see. Ray wanted me to ask if he believes the, I'm not sure if you're going to answer this based on history, but if you believe the squeeze for GME and AMC, although separate, if they're going to be anything akin to Tesla.
Say that again. I'm sorry. The beginning part of that question.
Oh, my apologies. Ray was wondering the squeezes respectively for GME and AMC. Do you anticipate them being similar to the Tesla squeeze?
Meaning the relentless nature of the Tesla squeeze, or the percentage gain, or what do you think he's referring to as far as like the character of that squeeze?
I'm not 100% certain because he didn't qualify that. I don't think we would hold you to numbers or anything like that.
Yeah.
Maybe to the same magnitude. I think is kind of like, is it going to be as intense, less intense as Volkswagen? Since Volkswagen's kind of like the last squeeze that's ever been talked about, really. Probably is it going to be like to the same magnitude, or is it going to be lower or higher?
So it's probably best to answer in two parts. Number one, AMC, like I said a little bit earlier, has this sort of look of multiple events, as opposed to a single, just crazy event. If, at least as far as my model's predicting. So my model was predicting a single, this huge, massive run-up. In AMC, I would expect to see the opposite setup of what I saw in the stock indexes in 2008, where there were just these, zones of weakness clustered within 2 weeks to 4 weeks from each other, all coming from, almost every fractal time frame I had. There was just total agreement that this one short period of time was going to be just straight down relentlessly. So I don't see that in AMC. I see, multiple windows. I saw the May window. Now I see the August window. Then, barring new data, the next most powerful window is more like December, February. So, it's not to say that it couldn't get completely out of hand to the upside. If it starts to, I'll be able to tell people when it's happening, because there's certain characteristics that I'll see that are similar to the 1987 crash, but flipped upside down, and then I'll be able to follow my topping count. As far as GME, AMC continues to look more bullish than GME to me. GME has a retest at $275, so that's sort of my public target over the next 2 months for GME. And I think I tweeted yesterday or the day before that I thought that was sort of a conservative, which obviously people who are long GME and love the stock, I was battered for that. That wasn't a high enough target. So, I'm not saying that's as high as it's going to go. I'm just saying that's something in my limited toolkit that I can talk about. Retest at 275 for GME. So AMC is more bullish than GME. There is one specific stock that I won't talk about much today, but that seems to be more bullish looking than AMC during the next month or two.
And they wanted me to elaborate if it was going to be as drawn out as like Tesla or Volkswagen.
So I've got these right now on the board, barring new data that's generated. I have the this August zone of strength, which is a big, powerful looking one. I've got the basically Thanksgiving-ish. I've got the December, February, then the next one is out into 2023 for AMC. That's why in the very beginning, when I first went public with the stock, I told Randall in that interview that there's nothing I see in AMC that looks remotely similar to a company going out of business. It looks more like a company that's, going to go through a series of short squeezes and also sort of reinvent itself and probably find new revenue streams that, sustain the stock even during downside periods of, temporary scares here and there.
Can you tell us what ticker that is that you're looking at?
Which one?
The one.
The most bullish of all of them?
Yeah.
It's one of the companies that I cover. I'll leave it at that.
Oh no. Okay.
No, wait a minute. I'm invested.
Oh, I know now.
So I'm just listening.
Yeah. So and I do have, so this is now being brought up 1,000 times. I know Citadel has his list still, but people were wondering what your thoughts were on BlackBerry. Is it in the same realm as AMC and GME, or is it kind of going to be its own beast?
Kind of going to be its own beast.
That's what I like to hear. I like when stocks become their own beast. It's what I used to call AMC back in, February.
Yeah, BlackBerry is another one that looks like it's in the process of being reinvented, or it already has, and we just don't know it yet.
Yeah, I could see that. And that's funny that BlackBerry is actually something coming up, because a little fun fact with me, I used to work at AT&T back in like 2010, 2011, and BlackBerry was like the thing to have because Apple like all the Apple phones and Windows phones and all that was just hitting the market, so everyone was still coming in and buying BlackBerry. So to see that they're one, still around, and two, if they're reinventing themselves, that would be awesome to see a company that's that old. Obviously it's older than 2010. Yeah, they go way back, but I think that's kind of what we're in right now, is the reinvention of all of these really old companies. AMC, GameStop's been around, forever, and it's, I don't know, it's phenomenal. Like, to see just people fighting to keep these companies alive. I think that's awesome.
Yeah. No, I agree. And although it may not be, they may not be known for their telephones, they definitely look like they're reinventing themselves in a vertical where there's a lot of money.
That's awesome. Citadel, do you have any more questions?
Let's see. There's someone wanted me to ask about a ticker that I don't recognize. It was GTT, or it's now GTTN. If you have what your thoughts were, that was left open-ended, the question.
Yeah, no, so it's one that I tweeted out and that I bought at $1, I can't remember, 18, something like that. And then it shot up to $4.25, which was a retest level, which was what I was, kind of playing it for. and then it collapsed. And they've gone through this, period where they were delisted because they haven't filed their paperwork. So sort of my stance on that one is, still long. It's classified as an all or nothing sized bet, BET, which, I don't call very many positions bets, but this one's in that category. And I think there's a, place, at least for me, there's a place in the portfolio for those types of things. So a bet for me is between, it could be as small as 0.5% of total capital. It could be 1%, it could be 2%. If I have a lot of conviction and think there's huge potential upside, but I also keep in mind that it could be a zero. So, the model shows zones of strength. And if the company just doesn't file their paperwork and they're toast, then obviously I'll lose my investment. If they file their paperwork, I have a series of retest levels that are at much higher levels. So, it could move from 50 cents to, into the double digits, attacking some retest levels. So, it's one that I've gotten lucky in the past. Mara, MARA, I bought at 50 cents and it went to $57, but it could have also gone out of business. I didn't have any inside information. I'd never met with the CEO or anyone at the company, never talked to anybody on the telephone. So I did a, all or nothing size bet and, didn't hold anywhere near the full position all the way up into the 50s, but that's sort of GTTN falls in that category. Super, super speculative, but I'm going to stick with it, and it's an all or nothing size bet.
Thank you for answering that. So I have one personal question, and this kind of comes as our community. So our community, we got brought this ticker by one of our own staff, first strike veteran Tyson, however everyone knows it. He brought Torchlight to us. I don't know if you've followed Torchlight and metamaterials and all of that. Do you know anything about it?
Nope, I don't. Sorry.
Really? Okay, so there was people asking if you would cover meta, but it is something, and I brought it to Dave Lauer too. It's kind of like this hidden thing, and I'm really trying to still dive more into it. But Torchlight and metamaterials did a reverse merger in June. And the phenomenal thing that they did, so metamaterials was a Canadian listed company on the Canadian stock exchange, and they did a reverse merger with Torchlight to get onto the NASDAQ with a new IPO, the MMAT. And they ended up doing a preferred share dividend based on Torchlight land whenever they sell it. So obviously it's not, they don't have to pay anything out until the end of December of this year.
What's the symbol? What's the ticker?
It's MMAT now. That's what they got newly listed. They're the only metamaterial on the NASDAQ. And so they offered a preferred share dividend right before the reverse merger for Torchlight. And all of us got, it was a 1-for-1. However many Torchlight shares you held by a certain date, you got that many preferred shares in Torchlight. And then to top it off, they did a reverse split on Torchlight right before it got merged with Meadow, so that it just killed all of our anything we were holding. So most of us have been trying to average down quite substantially because they have shorted it and everything here for the last month or so. But they also just bought a nanotech company. So it's something that I would love to see what you think about it and if you can research it, because it's they have they're using graphene technology. They have partnerships with some major companies. Like they have stuff with Samsung and Boeing and different places. It's just, you'll have to look into it, but that's something that a lot of us are kind of looking into because it's like 360, 370 a share right now or something like that. I didn't get to see the last ticker price. But yeah, if you ever could look into that.
Well, I'm looking at it right now, so hang on one second.
Oh, thank you. That's awesome. But yeah,
Nice of you.
I've had a few people DM me about this one, so now it rings a bell. And it looks like I've done a little bit of work on it. So let me see something.
yeah,
Um,
it's kind of a phenomenon that, I've never, and I've been trading for 10 years, different things, crypto, forex, whatever. And I had never seen a company do what exactly they did. And the CEO is all about, burning the shorts and all this other stuff. And they've actually had a lot of problems since they got listed on the Nasdaq with their the categories they're being listed under, because Torchlight was oil and gas. Obviously, metamaterials is way different than oil and gas. They do like energy and whatever. I don't actually know what they're settling on at this point. But yeah, they just keep switching. If you like on different days, if you go onto different brokers, they're listed under different categories, and it keeps screwing up with what they're trying to do.
mm-hmm.
So yeah, I don't know.
So, well, let's see. I'll share some retest levels with you guys. So two retest levels here that are both bullish. One at $6.45, and one at $12.90. So it would take me 15, 20 minutes to figure out and run everything on future zones of strength and weakness, but I can sort of eyeball and tell you that it looks like it's bullish here, and those are the retest levels. So it looks kind of interesting. Now it doesn't have, I can tell you off the top of my head that it doesn't have so when a stock has sort of long-term great prospects, the type of stock that can just continue to make, new all-time highs, like an Amazon type of a setup, it has a pretty specific look to it. So this one does look more like a trading stock for a while, as opposed to a stock that's going to move straight back above that, I guess it's the all-time high that it saw earlier this year.
Yeah, the all-time high, like I think that's when they did that reverse merger. Like it ran up, and then as soon as they merged, it just crashed. It was tragic, to say the least.
So really have a total blue sky look to it, where you're back above that. It looks like that was $21.76, I guess.
Yeah,
right.
Yeah,
in June.
Yeah, that was when they merged, and they did the reverse split and all of that craziness.
So $6.45 and $12.90, and that's a pretty big move from 364. So yeah, it looks bullish.
I appreciate that. I think you just made a lot of people breathe, especially like Citadel and me and a few other people that have call options and stocks.
I'm missing in on this action. Actually, I gotta look into this too.
Maverick, what are you doing? I mean, now's the time to get in, because it bottomed out. In my opinion, no, not financial advice. Everyone knows the saying. But in my opinion, it bottomed out a few days ago. Like, thankfully, we've been going up, and a lot of people have been able to average down. So it's like I think gosh, and Jim, you're probably gonna laugh at this, but most people were sitting at a $20 average for that one stock. And to see it go 20, 15, 10, 3, and we're like, oh no, we are going to be bag holding this forever. And we're talking people have like hundreds to thousands of tens of thousands of shares of this, and we're all going, well, rip our portfolios, because this is ugly. So I think you just had everyone breathe a little bit of a sigh of relief. And I would say
it's interesting. I'm sorry, go ahead.
I was just gonna say if you could definitely look into like the short interest and the utilization on this, and if you can find historical data on Torchlight and see where it was sitting, and it's an interesting one for sure.
I unfortunately have to stay away from all of that stuff. The biggest losses I've ever taken were when I knew the most about the company.
Oh, oh no.
Yeah, I have to just follow. I just follow the model and follow Nimoy and leave the rest up to people way smarter than me.
Oh, well, that works too. Fate. Just leave it up to fate at that point, because
Matter of fact, that is what created my deep dive into technical analysis and Elliott Wave in the beginning. Was a stock that I fell in love with because I had heard about it through one of my rich friends' mother at dinner, and I convinced my parents to buy it. It was called Barton Industries, and these guys were completely bogus, but they had tricked Chevron and a bunch of the major energy companies about some, it wasn't any astonishing technology. It was some sort of, basically computers with wireless technology, I guess, that could report back from remote oil fields, just different statistics and things. But, back then, it was a pretty big deal. I guess this was 87, 88, something like that. And I bought it, convinced my parents to buy it, and then they promptly went out of business, and they were completely lying about everything, and they tricked, like I said, they tricked Chevron and everyone else. And so that's when I said, if this can happen when I've worked this hard and have information that it's supposed to be a great company, and I've done supposedly the research, then this is for the birds. And that's when I went and tried to learn Elliott Wave. And then what happened again with Enron. I mean, those were some pretty smart people that were tricked by Enron.
Enron.
So
Hear, I hear Enron mentioned so much lately, and I'm like, oh, please don't put us back there. Please don't go back there.
Yeah, exactly. All right. Well, hey, thanks a lot for the opportunity to talk to you guys and meet you guys and talk to your audience.
I have one more question, and it's a silly question, and I don't know anything about it. I'm sorry, and then I will totally release you, and I hope you'll come back for a second interview, hopefully. They're asking something about a fish eyeball and Bitcoin at 18K.
Fish eyeball. I don't have to eat that fish eyeball because the guy didn't take the bet. So the guy challenged me that Bitcoin would not trade down to the 18,100 retest level this summer. Summer ends September 20th or something like that, which I discovered most people on Twitter think summer ends in July, I guess. But no, newsflash, summer extends into September. And the guy didn't take the bet. It was going to be a $10,000 bet. If I lose, it goes to Wounded Warriors. And then I was so confident in the call that I said, as a matter of fact, I think I came back an hour or a day later and said, I'll eat a halibut eyeball. And
oh Lord,
that guy didn't take the bet, I guess.
Oh,
because right now it's not looking too good. But so that's interesting though, because that 18,100 retest level, it is a retest level. It's valid. I've quadruple checked it, and so I absolutely will be looking for a move in Bitcoin down to the 18,100 level. Now, whether or not it can get there during my zones of weakness, it looks kind of unlikely unless it's all the way out into September. But I am confident it will get there, and we've got multiple zones of weakness, coming off of this high. Matter of fact, this is a good example. We talked about the difference in sort of the modern market and algorithms and everything else. My Bitcoin model had been really accurate. It, predicted the melt up into the high. It predicted the crash. And then it predicted during the trading range. It was very accurate, up and down for weeks. And then the zone of strength, I thought, would stall a couple $1,000s from where it is right now and head back down. So, that's an example of sort of an overshoot in price into one of my kind of zones of strength, and between a zone of strength and a zone of weakness, that I think is a function of sort of the modern market. That to me, that's something about it that looks, looks like it's more related to, in other words, a move that I wouldn't have expected to overthrow that much in, 10, 15 years ago. But anyway, yeah, so hopefully, I mean, he didn't take the bet. I'm not eating a fish eyeball, thank God.
Right. That's good. That's good. No, if it makes you feel any better, back in February, I was telling everyone that crypto was going to crash as it's doing its biggest bull run ever. And I'm like, guys, it's going to come down. Things that go up must come down. And it's like, and they're like, Kenna, no, you're wrong. It's like getting ready to hit 55,000. I'm like, trust me, guys. Crypto and housing, like I was sitting here telling everyone, I was like, housing's gonna go down. Like it's all the markets are bad right now. Like this is all being pumped up for whatever reason. I don't know yet, but so no, I'm right there with you. Bitcoin, it's gonna test another bottom. I don't know what, because I don't track it that much, but it'll go back down. And I have a feeling.
I mean, the markets right now. I mean, if you're wrong on stocks, you're wrong on crypto, you're wrong on, right. It's sort
everything.
of a one directional market for certain areas, which is not a good thing if they move in the opposite direction, like my model's sort of predicting. But anyway, thanks again for the interview. I'm going to head out of the office and go home.
If I may, I have one last question that'll be the easiest thing you'll have to answer tonight, if you don't mind.
Okay.
It's for those that don't know, where can they find your website? And secondly, my understanding was that you offer some sort of discount for veterans, perhaps. If that's the case, how do they get in touch?
So you can go to click the link off of Twitter, or just go straight to BAMinvestor.com, singular, BAMinvestor.com. And then for the veterans, click on the support tab, and you'll see a category called veterans, and send them your proof of veterans ID. It doesn't have to be the DD-214, I don't think. I've heard that that's sort of a hard document to upload. Sometimes the system chokes on it. If there's anything proprietary on any of your veterans ID information, whether it's a driver's license or whatever, just obscure it, and that's it, and they'll set you up.
Awesome. Well, thank you so much. I appreciate you taking the time, and my apologies for going over, but I know our YouTube crowd and the BullHouse subscribers are very ecstatic, so I appreciate your time.
No, thanks a lot. I appreciate you guys.
Thank you so much, Jim.
Thanks a lot, Jim.
Okay, take care. Have a good night.
You too.
Bye.
Night.
Bye now.
All right, guys, everyone on YouTube, I appreciate you guys hanging in there. Yeah, gosh, almost 2 hours. Oh, shoot. I am so sorry, Jim. We got a lot of great information, and if anybody in the call has any final thoughts, Citadel Maverick lady?
No, it was great. We learned a lot. It was awesome. It was nice, like you were saying, Kenna, that, it's not just whatever he's saying inside a small tweet, right? We can get kind of more of an expansion on that, and that's eye-opening. Yeah,
and his subscription, it's actually pretty cheap. I signed up for it like 2 months ago. It's $26.95. He had a special for AMC only in Bitcoin, and like he explains in his videos, which he releases like at least 2-3 videos a day inside like the portal when you log in, and he explains exactly like, this is what I'm saying, this is what's going on, and like he basically says we're gonna probably hit this and hit that, and like it's like the whole month of July he was pretty spot on. I mean, there was a few things that were odd, but again, it's not perfect, right? But he's been pretty good overall. So yeah, I enjoy listening to what he has to say.
And you can all blame the overage on me. I lost track of time because I don't know. I was engaged. I found it enlightening. So I'm to blame for the overage, but I'm glad everyone could, we didn't even get to all the questions, but I'm glad that everyone could join. For those in YouTube and Discord, we got as much of your questions out as we could. And perhaps we can circle back and again with him in the future.
Sounds
Definitely.
good.
Definitely, yeah. We'll definitely try to get him on again, maybe next month or so. See what's going on with him and what he's seeing with the rest of the market, because I have a ton of questions for October, January, for different things that I'm seeing. So, but I do want to say this, guys, we're all investors, right? This is gonna be my last little final thought on this, but we're all investors. We all come from different walks of life, and we don't know what everyone's background is particularly. Some people have been in for 20 years, 30 years. Some trade differently than others, so we just kind of have to treat each other with respect, and learn from each other. Just the way that we communicate and engage, and communication is the first step to understanding. So this is how we do it. We get as many people on, many brains as possible, because somewhere there is the truth, right? So I will see you guys on Friday. I think we are doing a Twitter Space podcast. So if you guys want to join us on Twitter, I'm not exactly sure what the topic is. Might be open mic, who knows at this point. But yeah, I appreciate you guys coming in. So good night, guys.
Right
Good
on.
night.
Have a good night.